Okay, we're back, and now we're going to look at some strategies for some tax planning strategies, things we can do to shift or minimize our tax burdens over time. There's a couple major ones. They are increasing deductible expenses, deferring tax deferrals, conversions, converting income to more favorable types of income, eliminations, timing of income and expenses, and tax planning for investments. So we'll go through these one by one and give some examples. So the first is increasing deductible expenses and credits. So obviously, a classic example is just increasing charitable giving. So let's just imagine that had a whole bunch of clothes you could donate. Well, they get that's a deduction at fair market value of those clothes that are donated. That would increase deductions and reduce tax in the year that donation happened. And if the family isn't getting any value out of these items, in fact, it could be a negative value if they're paying to store it, or if it's consuming space in their home. It can be could be a win-win, right? You get more space and you get a deduction. Again, that is subject to the standard deduction being large, but it matters. Another strategy is clustering. So, for example, on federal income taxes, you get a deduction for state and local taxes, and that includes property taxes. So, for example, a client could pay, the property taxes in January and then pay again in December. So that way they have double the tax in one year and no tax the next year. That in effect doubles the deduction, right? So the idea is you get above the standard in the year when you double down, and then you're well below the standard in the other year, and overall that increases deductions. The example in your book includes a self-employed person who decelerates billing in December, so they just get a lot of billings in January and not very much in December. And that the effect of that is to basically just delay that month of income for a year. Now, of course, that's going to show up in the next year, but if you delay over and over again over a 25-year career, that is a lot of money that the client had access to. Basically, they have that pool of money right there. So there's that pool that they didn't have to pay tax on until 12 months later, and so the tax is in their control for 12 months that it wouldn't have been otherwise, and that has an interest effect, right? So if they invest that money, they end up with more, they can earn interest on it, and they end up having a real dollar effect. So clustering expenses, right? If you think about a farm or a business, they can try to buy lots of stuff in January and December, and then if it's expensable, then they can pile that up. So there's lots of different ways to think about that, but clustering is a major one, and then just generating deductions is another. So tax deferral is a way where we're talking about delaying tax until later. And tax deferral is the key benefit of these qualified plans, right, where you contribute pre-tax dollars. The money earns, right, you earn money in the account, but withdrawals ultimately are taxed. So the tax doesn't go away, but because it's put off until so far in the future, right, instead of paying tax as a 22, 25, 28-year-old, you're paying tax as a 65, 68, 72-year-old. Those investment gains are huge, right? That money has had 40 years to grow, and so it ends up being much, 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 much bigger when it comes time to then take it out. And yeah, you pay tax when you take it out, but the fact that you've deferred it so long just puts you in a much, much better place. And so that is the big advantage of deferring tax. And there's lots of ways to defer it, but certainly qualified pension plans are the most common way to defer tax for regular folks. Another strategy is conversion. So usually we're trying to change income from earned income to some kind of capital gain. And there's, I guess, you can do shifting and you can do transforming. So an example of shifting would be, let's say I gave money to my child for college savings, right? So that doesn't get me a deduction, right? So that's all after tax money. But now the interest earned in that money goes on the child's tax return instead of the parents'. And the first $1,000 of earnings is for kids is ignored as like an incentive to get them to save, and then after that they likely have very low tax brackets because they don't have very much income, right? So at the end of the day, having the kids own it can have a lower you pay lower tax, but then, right, it's the kids' money, so so there's like, that's a household disruption. But if that money was going to be spent on the child's education anyway, and they do end up choosing to spend it on education, then it all works. But so that's an example. Another way well, that's shifting. So transforming is when we're trying to switch from ordinary to capital gain. So an example of transforming income would be to purchase a rental property, right? So you've taken money, and again, you're buying the rental property with after-tax dollars, so that doesn't happen. But after that, you have depreciation deductions on the property that will, that can reduce the effect of the rent, right? So the rent comes in, but you have depreciation, so you may not show much taxable income on the property, but you're still making, paying down the principal on the property. And then at the end, you sell it and generate a bunch of capital gains, but it's not going to be income. So doing a rental property changes the nature of the income you would have earned on that money you saved to be different than something else, right? So there's, so that's part of a strategy in the toolbox, is think about transforming income to different kinds of income. Tax elimination. So this is just getting rid of tax entirely. And so there's a couple, right? So an example here is establishment of a Roth IRA, right? Roth IRA is a specific retirement vehicle where you contribute after-tax dollars, right? So you're not deferring tax in this case, but the earnings grow tax-free. So at the end, when you're withdrawing money from a Roth, you're not paying tax on withdrawals. And so that in effect eliminates that the taxes on the growth, right? It doesn't eliminate the income taxes you paid to get the money in, but it does eliminate the tax on the investment's growth. So that's just an example of a way to eliminate tax. So transfer to children are another way. If you think about paying estate tax, or if you're going to pay estate tax, you can gift money to children. And that's right. It's after tax dollars, so it's not deferring or eliminating tax at that time. But then upon death, if the estate tax would have triggered, that money is out of the estate, and so the estate tax doesn't trigger on that money, right? So there's some strategies that all of the limitation of taxes, but obviously they're kind of very specific, right? There's certain things you have to do in it, and they tend to be pretty disruptive to households. Now, the Roth IRA is the exception, right? So the only way that the way that the Roth IRA is disruptive is that it doesn't provide current tax deductions like a qualified pension plan would. So that potentially reduces household cash flow now, but for a big benefit later on. So gifted charities have a tax effect, and those can be cash. they can be property, it can be investments, right? So this is where this gets interesting. So if you have let's imagine that you have a portfolio of stocks, maybe 15 stocks, and one of them just really took off, right? So normally normally if you wanted to sell that stock, you'd want to have an offsetting loss to cancel out the gain so that you didn't have any net gain that year. But let's imagine that you just had one that just totally took off, has a huge gain, and you don't have anywhere near the losses you would need to offset this gain. But you do want to you want to sell maybe or lock in those gains, right? So, if you were to donate those shares to charity, then the capital gains tax on any increase in value is eliminated, right? So let's say I bought at $10, went up to $100. If I donate those $100 shares to my church, now I'm not paying any tax. Now you don't get any money from that because you've donated it. But let's say I was going to make that donation anyway, right? So let's say that I was going to do a $4,000 gift to my church this year, and I say, oh, you know what? I should just give 40 of those big shares that shot up. It's still, right, either way, $4,000 is leaving my pocket, but now I'm eliminating a bunch of capital gains taxes on something that went up really high. So that's a way to do tax elimination through gift to charities. And then I obviously and charitable gifts are useful as deductions as well. So transfers to children, right? Just giving money to kids, right? So the first $1,000 of investment income earned by youngsters is not subject to tax. I don't think that changed in the recent tax law changes. I'm not sure. So that's an advantage for children that are investing. And so you can end up with basically more money. And they tend to have really low tax brackets too. All right, we talked about Roth IRAs. Structuring of employee benefits. So an example is medical coverage. If you have really great medical coverage, the money the employer pays for medical coverage is not income to you, right? What you pay is, but what they pay is not. And so having them pay a bunch of money on your behalf for really good medical benefits is a way to eliminate tax. The Affordable Care Act changed that a little bit, but basically it makes sense to have your employer pay medical care on your behalf because it eliminates tax. So another way to manage tax is the timing of income and expenses. So an example would be, so like with, so let's think about, I have a business. We already talked about this. Maybe you do a bunch of equipment purchases in December because you want to be able to use the 179 expenses to reduce income because you have a high income year. Or you have a low income year and you don't want the deductions in this year, you want them next year, so you wait until January to do it, right? So that's a timing of expense. Timing of income works the same, right? Maybe you want to get some income now because you have a low bracket now, so you accelerate some collections or billings now, and then that reduces income later. So because tax accounting is cash basis, it makes it easier to shift stuff around because you can you have some control over the timing of when cash shows up and leaves. So tax planning for investments, it is a lot about, right? The big part is you have long-term and short-term gains. They bunch together, right? So your long-term gains, your long-term losses can offset long-term gains. Your short-term losses can offset short-term gains. Short-term gains have unfavorable tax treatment. And so if we're tax planning with investments, if we're selling something, we want to have a corresponding loss to also sell to cancel out. And so So when we think about so on the investment side, the timing planning is around revenue because we're selling our investments and generating revenue. So we're timing revenue on the investment side. On the household side, we're often timing expenditures, right? So that's kind of the difference, right? So for a household, maybe we do a bunch of medical care in 1 year. That's an expense we're timing to maximize deductions. If I'm on an investment side, maybe I do a bunch of selling in a year when I have a lot of losses or when I have a lower marginal tax bracket. So, and generally the reason for this, right, that third bullet is that you don't, as a household, you generally don't have a lot of control over the timing of your income. Self-employed folks do, but if you're just drawing a salary, it's just coming in, consistently every 2 weeks or every month, and you don't have control over that. And so you have to time the expenses instead because you don't have control over the income timing. So that what I mentioned, the short term, long term, that's for capital gains and losses. That's when you sell, right? That's like stock price appreciation or depreciation. But you can also get dividend income and ordinary income from investments. So, right, so if I have stocks and they pay me dividends, that itself is dividend income. It's not capital gain income and is taxed differently. And then ordinary income has the worst rates. Generally, and that's what you get on like interest or you might, if you have an investment in an operating business and you're an active participant, you can generate ordinary income that way too. So all of those different incomes have different tax rates and different treatments, and they don't tend to offset each other, right? So if I have a long-term loss, I can't use it to offset ordinary income. So dividend income has a lower tax rate. So qualified dividends are eligible for special tax. Almost all dividends are qualified dividends. I mean, if you're buying from a public company, right? If you just bought a stock on the stock market that paid a dividend, that's almost definitely a qualified dividend. I think the exception to that are, right, so REITs don't have qualified dividends. So, but for productive regular firms, the dividends tend to be qualified and get subject to this special treatment. So you have to have held it for at least 60 days, and they had to have paid tax at the corporate level. And there's some special, right, and so for clients it doesn't matter because there's special rules when corporations pay dividends to each other, but that's not generally going to be something your clients deal with, so that's not important. Right, so short-term stuff. Net short-term losses are limited to $3,000 per year, right? So that's a problem, right? So if I have a big short-term loss, it's getting. Let's say I have a $20,000 short-term loss. Well, it might take me as many as 7 years to benefit from that loss, right? It depends on how things all shake out, but so that's a big disadvantage to short-term losses. And so you can't, right? That's where like having a lot of short-term losses doesn't necessarily, right? You can't have a big long-term gain and then a bunch of short-term losses and have that work out tax favorably. So long-term ones are held for at least a year. They have tax-favored treatment, and so long and short-term investment transactions are netted against one another, right? So you sort of think about them as separate bins, really. So ways we can use this to do tax planning. So if it comes to December, right, we can harvest, in a sense, capital losses. So let's say we had a broad portfolio of stocks and we had a couple that just were duds. So then you sell and generate a bunch of losses, and that will give you the benefit of that loss in this tax year. So if there were gains to offset, that's perfect, right? If you had gains to offset, then you can sell, take the loss, offset the gains, and that it eliminates the tax because there's no income to tax. Right? You didn't make money. You lost money and made money, and it canceled. So the so so there so that's an advantage of doing. Obviously, the disadvantage is then you don't own those shares anymore. So if they took a big loss, they were going to come back. But I mean, just in general, you don't know that, right? But if you had an investment thesis reason for wanting to continue to hold the shares, that would classify as like a household disruption, right? You had to sell something. You just chose to sell something maybe before you wanted to because at this moment the tax benefits were really good. Another strategy is rather than accelerating losses, you can delay gains. So maybe we harvest gains in January, and then we have, then we're not paying tax until the next year. So that gives you 12 months to use whatever money you're going to pay in tax. You have access to it for 12 months, and you could earn interest on it. Also, you could delay so that you've held it for more than a year and turn it into a long-term gain. Right, so postponing allows you to delay recognition of the tax and potentially change the gain over to a long-term gain. So timing is really important when we're thinking about getting cash out of investments. There's also some investments that are tax advantaged by statute. And there's a bunch of them. There's investments. There's investments that have tax advantages, and there's structures that have tax advantages. We've sort of been dancing around the structures already. So there's a bunch of pension plans that have the tax advantage structure, or where you contribute pre-tax money. Qualified pension plans, traditional IRAs, individual retirement accounts. Those all allow pre-tax dollars to be invested. Then the Roth, it's post-tax, but you grow without paying tax further, right? The income tax on the growth is eliminated. Employer plans can have a tax advantage, even if they're, you get the pre-tax dollars and tax deferral, just like you would for a qualified plan, but maybe it's like created by the employer. Okay, so those are structures, right? And then investments that have tax advantages are tax deferred annuities, right? So after tax dollars are placed, and then the tax on earnings is delayed until the annuity pays, right? So, you're kind of buying into this product by paying money over time, and it's growing in value, right? In fact, they're investing in your behalf, and then at the end, then they start cutting you checks, and you pay tax on the checks you get, but you weren't paying tax along the way. Like in a way, it was growing in the background out of your notice, tax advantaged, and then those annuity payments become tax. So so there's tax. So that's nice, because if you tried to do that yourself, like if you tried to create an annuity for yourself, you wouldn't have access to that, right? Your investments would be taxed as they grew, as you were realizing gains, rebalancing the portfolio. So that is a tax advantage. And life insurance also, right? So you pay for life insurance with after-tax dollars, but there's the life insurance can have a surrender value that grows, and that growing surrender value is tax deferred, right? Earnings that increase the surrender value of that life policy are tax deferred until you realize that gain and cash in the policy. The life insurance thing can get kind of wacky too, right? If you're at the very, very end of life, let's say you're in your mid 90s, you can get in a situation where, there are life insurance products where it's you pay, $7,000 or $6,000 for $10,000 of life insurance, something like that. And the advantage is that if, in the event of your death, then those life insurance proceeds go into the estate. And so it's right. So rather than having investment gains that were taxed during the client's life, you have life insurance proceeds which go into the estate, which has favorable tax treatment. It's not, it's kind of goofy, but it is that this does exist, just as an example of how life insurance affects tax affects tax as a tax strategy. So individual tax advantage investments. So there's investments that are advantaged. So first of all, your primary residence has a bunch of tax advantages. So the mortgage interest is tax deductible, again subject to that $12 or $24,000 standard deduction. The real estate taxes you pay in the home are deductible. Now you signed yourself up for real estate tax, but you're going to do that anyway, right? If you rented, your some of your rent is going to pay property tax on the property that you're in. So either way, you end up paying real estate tax. You can't live in a house and not pay real estate tax. But if you own the home, you get the tax benefit of it, right? So the mortgage interest is tax deductible. The real estate taxes are a deduction, and then income on your primary residence I think it's like if you live in it 3 of the last 5 years at the time of sale, something like that, then there's a whole bunch of gain on that house you can avoid paying tax on. I think it's like $250,000 or $500,000 for a married couple, something like that. So it's there's you can eliminate a lot of tax on the capital gains sale of a primary residence. So that's a big one. But real estate, even non-primary residence real estate, so rental real estate has a lot of tax advantages. A big one is that real estate appreciates, but it depreciates for tax purposes, right? So you have a property who has losses for you to use against income that aren't real generally, right? At the end of the day, you sell this property that has gone up a lot. Now, right, the property itself has declined a lot in value on the taxes, and so you get hit with a really huge capital gains tax if you sell. But that assumes, right, so there's a couple things. So first of all, maybe you don't sell, maybe you just do a cash out refi, or you do what's called a 1030, I think it's 1031 exchange, where you flop, where you maybe you sold this property, but you just bought a different property. So you still are in the property business, and there's rules about it, and there's ways to do it right, but that basis kind of gets passed on to the next property. So it doesn't avoid the tax. You still have to pay the tax, but you're deferring it for longer and longer and longer. And with real estate, you can kind of defer it almost indefinitely, right? So there's big tax advantages to real estate investment. Municipal bonds have tax treatment. So these are like, the local school district wants to build a gym, so they sell a bunch of bonds to raise the money to build a gym, and local investors buy them. And right, so most of those municipal bonds are free from federal tax. Right, so you don't have to pay federal tax, and often you don't pay. Right, so if you live in Wisconsin and you're buying a local school district bond, or like a local bond, you'll get potentially exempt from state and local taxes as well. And so that's a lot of tax exemption, right? So if you have a high bracket, getting a really low return on muni bonds is potentially still okay, because your after-tax return might not be so bad. And again, these are low-risk investments, right? It's the number of when municipalities go bankrupt, it is very unusual, right? So Orange County did one. I think Vallejo, California did one. I think there was one other one in recent, but it's kind of like they're so rare we can actually name the ones that happen. So they're pretty safe, generally. That's different than right? If you get a church bond or a really tiny school district, that's different. But yeah, the point is that they have pretty significant tax advantages, but they also have pretty terrible returns for that reason, right? They know they can get away with not paying very much because they get the tax advantage. So these are interesting. So another tax advantage security is the Series EE bond. So it's a government bond. So you're lending money to the federal government, but what happens is you earn interest on the bond, right? So it's a bond, but you would earn interest on it. But the interest is not paid out. It's deferred until the bonds are cashed in. So in a way, your interest is kind of growing and growing and growing, and you're not paying tax on that interest until you take the money out. So it kind of functions like the way a qualified pension plan functions, right? Where you put, you don't get you don't get a deduction. You don't get an adjustment to income, but right, that growth is happening without paying tax along the way, and so it's kind of a unique structure. But then you don't get any cash, right? So there's no cash you get out of it. So it's pretty. So it functions pretty well as like a retirement savings vehicle, right? So you get a Series EE bond. It doesn't give you any money, and it just kind of hangs out for a while, and then eventually it pays you, and that's when the tax reckoning is. But in the meantime, you can kind of hang out and shelter tax. There's also kind of the tax code is incredibly complex, so there's specific provisions that give tax advantage to oil and gas investment, low income housing, there's just sort of there's a laundry list of weird things that sort of are slightly advantaged with respects to tax treatment. So, just for an example, right, if you have, in general, if you are traveling for work and you need to eat at restaurants because you're traveling, then there's a certain tax treatment for the way those meals are taxed. But if you're a long-haul trucker, they also have a meal thing, but that meal treatment is different. It's a little bit better than what everybody else gets. And so, so that's a tax advantage that long-haul truckers receive relative to other careers. And the tax law is kind of full of these things, right? Little one-off random things that have a tax advantage status. So like oil and gas, one of the things that does it is they don't, these mineral resources don't depreciate, they deplete. And depletion is treated differently than depreciation. And depreciation is, well, you bought it at this price and it declines to nothing. But depletion can sometimes go to like less than nothing. So it ends up because they have a different system for it, and the different system ends up being a little bit better for tax. So for that reason, things that deplete have a slight tax advantage over other things. Now again, it's a market in equilibrium. People are going to take advantage of those tax advantages, and it's going to drive up that's going to drive a lot of dollars into those, and so the opportunities will decline because you're in a more competitive market. So it all kind of washes out probably, but that doesn't change the fact that there's some advantages out there for specific kinds of investing. So yeah, that is in short tax planning for clients. So right, obviously there's a ton of law to know. And there's a ton of different ways to get at it, but it is very, very important in that it's a big dollar amount, and if you think about just about anybody who walks through your door is going to probably be interested in at least strongly considering a qualified pension plan, and needs to understand the tax implications of owning their primary residence or not, and potentially needs to understand tax implications for simple, financial investment transactions like owning rental real estate, or the timing of realizing capital gains on a portfolio of stocks. Right? These are things that It's not that unusual, right? It's certainly not unusual for people to have a 401k plan in a home, right? So this kind of tax effect is really, really common, right? Basically, you'll be thinking about these issues with every client. But then of course there's, the really specific things that might only matter for one particular person. So there's sort of like a ton to know, but some that it's good to know really well because you'll encounter it so much.